Okay, thank you everyone, and great to be here in Alexandria for me for the first time. So I'm Marc Nassim, I'm managing director and partner at Awad Capital. We are a boutique investment bank based in Dubai and specialize in technology. So I'll be moderating this panel, and we have a great panel of experts, entrepreneurs, investors, advisors, and so on. So I'll ask every panelist to make a quick intro, 30 seconds, 1 minute tops, and then we'll start the questions.
Okay, let me start. Hi everyone, very happy to be here in Alexandria. My name is Hossam Taher. I'm an entrepreneur. I started a company called Cairo Sitters that didn't go so well, then started another company called Orcas in the education technology space. We were able to grow it over a period of 4 years, expand to the GCC area, raise money from a lot of the VCs that you're probably aware of in the region. And then we were able to successfully exit at the end of 2023 to a regional player. And I'm very happy to be here today and share the little bit I experienced with you.
Assalamu alaikum. My name is Craig Mullet. I'll give you my summary in 4 A's. So I'm American. I'm based near New York City. I'm African. I'm South African and have investments in South Africa. As my third A as an angel investor, and I'm also an advisor doing M&A deals globally.
Thank you, Marc. Hello, everyone. My name is Magdy Shehata. I'm a Swedish-Egyptian tech entrepreneur. Started a gaming company 9 years ago. We listed the company 2021, so we did an IPO. And now I'm the CEO and founder of Söderhub. We help Nordic companies that would like to expand to the Middle East with market entry, capital raising, strategy, and talent. And I also do some angel investing. Oh, thank you.
Hi, good afternoon. Great to be here. My name is Bassem Raafat. I am a mergers and acquisitions banker turned Africa-focused PE investor turned venture capitalist. I work for a VC fund called A15. We invest in early stage technology and technology-enabled companies in the Middle East and North Africa region, and we're based in Cairo.
Hi everyone, it's great to be here with you. I'm Germine Bouchnack. I actually started off my career in the SME banking space, mainly kind of facilitating collateral-based financing and shifting mindsets of traditional banks when it comes to that. And then moved into the VC ecosystem, first with Flat 6 Labs, and now I'm with my company at MEVP. So briefly about MEVP, we're actually one of the oldest VCs in the region. We've been in the market since 2010. We have over $300 million in AUMs. And we typically focus on investing in Series A and B. That's our sweet spot across the entire MENA region. And of course, we have successful companies in Egypt, such as that we're proud to have in our portfolio, such as Money Fellows, MNT Halan, Udewi, among others that we have in the region. And yeah, pleasure to be here with you and looking forward to the discussion with everyone.
Thank you for the intro. So exit actually is one of the most important timing, most important events in the life of an entrepreneur and a company. So I would like to ask probably Hossam and Magdy to share their views on the challenges and the opportunities of exiting a business in emerging markets.
Sure. Okay, so I'm not an expert on exiting, but I can share what I know in my experience. So the opportunities back then when I sold end of 2023, and the reason I'm mentioning the date because it's also the external factors that played a role at that time that affected a lot of the opportunities and the challenges that were at that time, basically. So we were a company that's based in Egypt. A lot of the team members are Egyptian. We were exporting our services to high purchasing power markets in the GCC area. So what we were able to leverage was actually the devaluation coming up. So it's like if the devaluation happens, then the margins of our business improves, especially that our revenues are coming in a stable, more in a stronger currency. So we were able to really leverage that opportunity, and we thought that despite this being actually a very big threat to us being able to raise money in the future, we were able to leverage it at this moment as an opportunity for external acquirers to look at Egypt and look at Egyptian startups as a target for them, which we saw happening moving forward. The challenges, of course, were lack of know-how, and I think we have advisors for that exact reason. A lot of the entrepreneurs maybe are really good at building companies, at motivating people, at coming up with processes, go-to-market strategies, etc. But they haven't sold a company before, and even now, after I've sold one company, I still know I only have one example to learn from. I probably need another 99 to have like a data set that I can learn from. So the lack of advisors or the lack of know-how in this small space was a challenge that we had to figure out and probably make a lot of mistakes in.
Yeah. So before I say my point, let me ask you guys a question. How many of you here are entrepreneurs? Like you started your own company and maybe thinking of an exit? Anyone here? Yeah, one, two, a few. Okay, cool. How many of you are thinking to start a company and eventually would like to exit? Okay, a few more. That's great. So it really depends when you want to build an exit strategy, right? On the size of the company, on your revenue sources. Because, for example, in Hossam's case, where the revenue was coming from a stronger currency, as you said, it's coming from abroad. But what we've been seeing in emerging markets is that due to these cycles of currency devaluations that have been happening, buyers could basically play a waiting game, because you know that everything will be on discount if you just wait a bit more. And that kind of delays all the deal flow a bit, or a lot, depending on the market situation. So it's not really like an Egypt unique thing, but we've seen that in a lot of emerging markets. And I would say this is one of the main challenges, really. So you have the devaluations, that's a really big risk. We also see the legal framework at large could be a risk, because in a lot of the emerging markets, again, I don't want to name any specific country per se, because it is a common phenomena that we see that regulations could change fast, and that could freak out potential buyers coming from abroad who are not very familiar with how things work in emerging markets. So while it could be very straightforward to acquire a family business in Spain or in Portugal that they want to exit, they've been running it for 40, 50 years. When you want to do similar things out of emerging markets, it tends to be very tricky. So also the regulatory framework is a second challenge.
Yeah, actually, I want to drill a little bit more on the regulatory framework. It's not only regulatory framework, but also the political instability, the economic fluctuations, which happens and very regularly in emerging markets. So how also from an entrepreneur perspective or an investor perspective would you deal with that? So probably also Magdy and probably...
I mean, I was coming to the political instability as my third point, exactly, because this is also very challenging. And sometimes, in emerging markets or in a region like the Middle East, North Africa, when you get bundled together, when you have a war just like few hundred kilometers away and the entire region really is not resting per se, it's not good optics, or it's not easy for foreigners who would like to come in and buy to do that, giving all the circumstances, right? So political instability in your own country or even the ones around can really also be very challenging. So we always say companies, like entrepreneurs building companies in emerging markets, it's like playing a game but choosing difficulty on hard. It is definitely not easy due to these 3 points, I'd say.
So Bassem, if you can add something.
Let me add something. I want to share a story that really puts this into perspective. So building and scaling and exiting companies in emerging markets is a massive uphill battle. The story I want to share is a discussion I had with a large global technology investor based in the US. And they were looking to invest alongside a UAE sovereign in a UAE-based company. And the feedback he got from his investment committee was that the UAE is very exotic for them, and this is a big stretch. So that really puts into perspective if something like the UAE, which is probably the most stable, predictable country in our region, is perceived as exotic and a stretch from a risk tolerance perspective. That just means like places like Egypt are probably not even on the spectrum. So with that context in mind, I think building and scaling and exiting companies, it just goes to show how difficult this is. So the topic of exits. So exits, you have 3 routes, right? So 1 is going public, 2 is selling to a financial investor, and 3 is selling to a strategic investor, broadly. If you look at the region we're based in, we've had 4 IPOs, 2 of which were in the region that I'm aware of. There might be more, and please correct me, but I think there were 2 in the US, so Swivel and Anghami. And then you had Fawri in Egypt and Jehiz in Saudi. So that probably tells you that if you're planning an exit, hoping and planning for an IPO.
Very soon to Dubai.
Sorry?
Talabat.
Talabat coming soon. So that would be number 3 in the region. But that just goes to show that IPOs are not really the likely exit path for you if you're frankly one of the few that will exit, which puts you in an M&A bucket. So I would say one needs to plan quite early for exit, because these are not events that just coincidentally happen and things fall into place. These are things that you really need to have a plan for. Similar to how you plan for product market fit, go to market, you need to have a strategy for it. And it needs to be a living document that is evolving with your business over time. In terms of challenges, as I mentioned, there's a lot of macro and political instability headwinds, which make exits very difficult. But on the flip side, on the opportunities front, you are building in a market that is, frankly, relatively difficult to do business in compared to other parts of the world. And this is a region that has promising growth prospects, and a region that global businesses will want to expand to at some point. And expanding through M&A and through kind of bolt-on acquisitions is a strategy that has been prevalent for many years and is something that we've seen a lot of in the region. So making sure you are on the radar of prospective buyers is very important. Understanding what these buyers look for, and are you building something that is solving for their end game? So is it, for example, a single market where you go very deep, or is it multiple markets where you are less deep but you're broad? Is it products that people are looking for? Figure out what the potential buyer universe or multiple universes of buyers are looking for, and just make sure that you're very tactically thinking about what you're building and for whom as you scale your business.
Craig, please, I think you have something to add.
I was going to pick up. That's exactly accurate. So I do strategic buy add-ons for big clients. And as an angel investor, I always encourage my startups to build towards what I call the 5 T's, and I have a workshop on that this afternoon. And it picks up exactly on some of the comments you're making. So a strategic is looking at, the first T is your target market, making sure that you're in both a geography and a product area that they're going to be interested in. And obviously when you exit, you want to be as far along as you can in each of those 2 categories. The second T is your technology or product. Do you have IP? Do you have something unique? Do you have a secret sauce that you're able to offer a strategic buyer that they can't develop themselves? The third T is your team. Is it not just you? The more the company is a real team of experts across different fields, the higher your valuation is going to be on your exit. The fourth T is your traction, which another way to say that is your numbers. Make sure your numbers are as solid as you can get. There's always a bit of a conflict there sometimes between the entrepreneur and the investor, because entrepreneur always wants to be further along, bigger, better. But there's a point in time where really waiting another year, the value of the company may only move 5 to 10%, which doesn't really move the needle for investors who want to see growth of 20 or 30% a year. And the final T is your terms, your valuation. What's a realistic number? Get an advisor that can talk you through what your expectation is, because I've seen lots of deals fail where the sellers just honestly have an overinflated view of what the company is worth. So get a sense of what the market is and then close the deal.
Yeah, actually, it's not only the entrepreneurs. Sometimes the investors also have
Yeah,
Germine.
I do agree on all the comments shared here, to be honest, and it reflects quite different perspectives. And also to touch a bit on some of the points that were mentioned. So, as Bassem mentioned, the IPO market is still a very long way to go when it comes to opportunities within the MENA region. And that kind of, I would say, two main factors impact this a lot and impact the involvement of that. First of all, as the MENA region, as homogeneous as it may seem, or us always linking the countries together, those countries are actually quite diverse when it comes to target segments, when it comes to problems that need to be solved, how to tackle it, regulations. And we see this in multiple industries, specifically fintechs, for example, different regulations and different sets. It's a whole story to expand the fintech from Egypt to Saudi. Despite of the culture, there might be cultural nuances that are similar and all this, but still it's very challenging to grow a company in the region beyond one market. And hence this kind of hurdles also the IPO story, because at the end of the day, you want to see like a strong company developing in multiple markets, especially if some of them are as volatile as Egypt, and you need to stabilize them a bit with other markets. So that's one thing. The second thing is, again, back to Marc's point on regulatory environment and the sovereign wealth funds and other regulators pushing for smoother IPO options and more options suited for tech companies to list on the market. So Saudi is having a head start on that, along with Abu Dhabi as well. But Saudi, we see the Numo market initially for the SME segment and so on. And now a lot of the ones that were targeting Numo, they're trying to bridge the gap to Tadawul's stock market, which we believe there's a huge kind of stock of potential companies that will be listing over the coming period on those markets, and hopefully they would be like create success stories that others would look out for. Because again, as Craig mentioned, driving international investors and also hinting on Bassem's point, they really need to see liquidity in the market. At the end of the day, when they're coming in, whether as investors or as buyers, potential buyers, they want to see liquidity, they want to see ability to expand not only in one market, but in multiples. So I think having more expansion between different countries for a single company, that helps more, whether the M&A story, which is the most prevalent, especially in the current market dynamics. We see people are, the IPO market in general, not only in the region, is kind of, people are usually worried about what could happen on that story. So it's a buyer's market now. Build your company, scale it to the right markets at the right time without doing it too fast, or you'll fail in some cases. And the second thing is pushing investors should collaborate more with sovereign wealth funds to encourage kind of more prospects for IPO markets.
Magdy, you want to add something?
If I can add, this just shows, like from this discussion, I think how there's also a gap. I mean, if there are any entrepreneurs here who are looking for ideas on what to do, there is a gap in advising and managing that last mile of a life cycle of a startup. And one of the things I really like, maybe people will recognize the name. عارفين Nagati? Do you guys know Nagati? Yeah, معروف Nagati. So Nagati have started exits, right? And he's I really like that because he's bridging that gap of the last mile. So he's advising on how to exit, what to exit, secondary markets, buyers. So it's happening, but it will take time. We've had a very tough 2023 and 2024. We've seen capital really drying up almost everywhere except the GCC. I mean, the West have had really tough 18 months, I would say. I mean, similar in China, in Japan also, it wasn't a really good situation that happened in the last 3-4 quarters. But with this coming back, hopefully sometime Q3, Q4 2025, we will see more capital being deployed. We will see the need maybe for some of these companies that have delayed their exits over the past 24 months wanting to exit. So we will have hopefully more exits coming in the region sometime 2026. At least that's my prediction.
Inshallah. So, Hossam, I'll go back to you as an entrepreneur who exited a business. What are the key indicators that tell you as an entrepreneur that it is the right time to exit or no?
So again, the indicators are different from a company to another. They're also different from the goals that you have for yourself. Like if your goal is to exit at a certain level or to achieve certain scale before you exit, then those become your indicators. Of course, they might be different from the investors' indicators that might be more driven by the life cycle of the fund, when they want to exit, if they want to recycle, if they need to return cash to the or cash on cash for their investors. But let me say it in a let me answer that question in a different way. Like, if I were to do my next company, what would I do differently from the start? So I would, very important, like I'll still put a huge factor on customer centricity. I'll still make sure that I'm solving a real problem, that I'm really adding value to the users, that I'm really obsessed with what the users want. However, there will be a huge layer of designing and engineering, very numerical, very straightforward, how I'm going to exit. Like, if I know that I'm operating in a certain space where the buyers are 1, 2, and 3, and those are at the time of decision making the buyers that I'm building for, then I would make sure that my tech stack is integrated with their tech stack. I'll make sure that my mentors are probably VPs or people who work in those companies, that my network is those people. So engineering for an exit from the start is not a bad thing if your goal eventually is to attract the best investors and to exit at high numbers. And based on what I said, you will be able to identify what those indicators are, whether if I'm selling to a certain company and my business case revolves around giving them access to the MENA region, I can't be an Egypt only play. I'll have to be in the MENA region. If I'm selling, so those would be the indicators, for example. I don't want to take a lot of time, so the audience can probably build on that.
Yes, great, please.
I'm going to pick up on one thing because this last mile is really important, as was referenced. But one of the things about getting good advisors and having a good board, you can also be quite creative in how you exit. So one of my startups a couple of years ago was in the kind of biomedical space, and the CEO was convinced there was a big future still for the company. The investors had been in for a while, they wanted an exit, and there was a strategic buyer at the table for quite a lot of money, around $100 million. In the end, we split the exit in 2 stages. Money up front and a substantial earnout. The earnout equivalent to almost double the exit payment. And it was really win-win because the investors got immediate IRR. The CEO and the management team was highly incentivized to stay and to grow the company. And the investors shared in the earnout. It's like, as an investor, it's fantastic because every quarter we get an earnout payment. And that's almost like a textbook on how it can work well. But it took a lot of creativity, and obviously there was risk. You know, the earnouts can blow up if your product no longer sells, and you can have integration issues. But I think thinking creatively about how to align those interests can add a lot of value to everybody at the table.
I have to say I need to echo that because in my gaming company that, as I said, we went public with, we do a lot of M&A, so we acquire other gaming companies throughout Europe. And this is exactly the best model we found so far. Money up front with huge earnout over the next 3 to 5 years. Lock in the entrepreneurs, get more out of them for the company, for themselves, but ultimately also for the group. So yes, 100%. I agree with this strategy for sure.
Great. Actually, I want to ask a question about the potential conflict or the conflict or perception of conflict, whatever you want to call it, between founders and investors, whether angel or VCs or institutional. How do you manage the potential conflict when someone wants to exit and the others say, no, you have to stay, you have to keep going?
I can take a shot
Yes,
at that. Actually, that's a very good question because honestly, it's something that inevitable because at the end of the day, it's not necessarily conflict as much as different backgrounds. So, مثلا, I would echo what Hossam mentioned. In his case, for the exit, we were just talking backstage. There might be, for some founders, there might be some other aspects that they consider beyond the company that would be very important for them as well. So I think it's all about, again, echoing what Bassem said, working on very early. So, for example, for us at MEVP, exits is not something that we think of at later stage after a couple of years. We actually do have a chief exit officer, which I think
you are the only one.
yeah, I think I think we're the only ones who have that. But this kind of echoes the importance of strategizing and working as much as possible hand in hand with the founders to see the right path, so it doesn't become like something of a all of a sudden kind of thing. So first of all, working early on it, identifying who can potentially be key buyers, and identifying also always checking in with founders and understanding their mentality. And I think that's the importance of a well-diversified board with different perspectives, and at the same time making sure that if the founder is not incentivized, you don't have to push them to be incentivized. You can find innovative ways, as Craig mentioned, where you can maybe kind of shift management, you can work around that. You also need to plan kind of what goes beyond, even after the exit, because it doesn't usually, a lot of hassle happens just between agreeing on the initial terms and closing the transaction. And if there's a huge conflict, things won't work. So you make sure that as much as possible, it's a win-win for all, while maintaining at the same point your LPs in sight and your IRR, and again your MOIC basically on those transactions. So yeah.
So,
Okay.
Bassem or Magdy.
I wanted to play a different role here because Marc, you're a great moderator, but also you guys work in the space of this like big exits, you know, towards the end, big tickets. So I think the audience also will get a lot of value hearing your view on that.
No, usually we work, I mean, we defend the interest of the shareholders of the company, be it the founder, the angel investors, or the VCs. And usually we are appointed by the company itself. That means that we defend the shareholders. And usually we play the role of the in-between between the different parties if any potential conflict arises. And usually we are, you know, the wise ones, telling them, you should do this, you should take that, and don't do this, don't exit now, it's not the right valuation, or you have to exit tomorrow because this valuation you are getting today, you will not get it after 10 years. So so we are very, very pragmatic when
you
it comes
deliver
to
the sober view.
Exactly.
Yeah, the adult is in the rooms pretty much. Yeah.
Exactly.
I just wanted to say, like, there's also an ideal answer that probably never takes place, where if the founder or the managing directors of the company are mature enough to understand the investment thesis and the exit thesis of their investors, and they understand when they want to exit and at what multiple and how they operate their investment firm, and also the VCs are transparent about it, and also I don't want to call it fair because most of the investors I worked with were very fair, but like being fair and not greedy before fair is also very important because it enables angels as well as VCs as well as founders and common shareholders to really get a piece of the pie at exiting. What I've seen since I sold the company, I spoke to the handful of people who exited their companies in MENA, and I noticed that angel investors usually are dismissed or are usually those who are buried down by all the liquidation preferences.
The pecking order, of course.
Yeah. And they're the ones who actually put money, and they're usually very upset, which
probably
kills
took the most risk
the
because they put
infrastructure of the
money
whole
on it.
ecosystem. So I think the maturity of the market, the transparency of all the investors, and being fair, making sure everyone is going to get a piece of the pie is very important. Probably ideal, but very important to at least strive for it.
So I think conflict or lack of alignment of incentives is probably a spectrum. You can be super misaligned, and I don't think the other side of the spectrum is zero misalignment, because there will always be some misalignment, but I think the challenge is trying to make sure you're on the low end of that spectrum and managing that low level of misalignment very transparently and with a lot of communication. So how can one avoid that high level of misalignment? I think one is just structuring deals, how you structure deals. I think we see deals with like 2 times, 3 times liquidation preference participating, where basically the founder needs to 10x their business before they start making money. So obviously there's going to be misalignment. So I think avoiding very complex structures and just keeping things nice and clean vanilla usually helps end up on that lower side of the spectrum. And once you're on that lower side, I think it's very important to remember that companies and that we invest in, at least, it's predominantly almost always about people. So you're backing founders first and foremost. You're backing the team that the founders have built. And these people have other considerations outside of the company they're building. They have families. They have personal commitments. They have, God forbid, personal emergencies. There's a lot of things that one needs to be very mindful of and transparent with the founders about. And just having honest conversation about, maybe a founder says, I'm burnt out. I can't do this anymore. At that point, selling may not be the only option. Okay, let's find an amicable way to transition to a continuation plan after your departure, with you potentially staying on as an advisor. So I think if a mature, honest conversation happens about it, I would say most of the time you can find a path that is almost perfectly aligned.
Craig, please, we'll end with you.
I was about to say, I think, great having a chief exit officer, which is a CEO, which really as founder, you should always be the chief exit officer, both when you build the company, and then I think, whether it's a board meeting every quarter or a review every 6 months, where you're constantly reviewing it so that you get this alignment.
Thank you all. Sorry, we ran out of time. If anyone had a question, you can ask us after the panel. Thank you all for an amazing panel.
Thank you for having us. Thank you so much.
Thank you.
And thank you all for being here.